If you're trying to time the trade talks, your next guest says that a deal might be coming sooner than later. Let's now bring in John Stoltzfus. He is Chief Investment Strategist at Oppenheimer. Happy to have him on set. You remain optimistic about the markets. You remain optimistic about trade. How?
Still bullish after all these years. It just looks to us that what we've got here is we're building towards a crescendo. All the mayhem in the tweets and everything else, the retaliatory remarks from China. Yet the underlying case is both leaderships are getting a lot of heat back home to get this done so that they can get on to other things. Whether they ultimately recognize it or not, or how soon, it's hard to tell.
I don't know if this is a controversial question or not, but if we are headed into recession, and we don't know, listen, everyone's talking about it, it may not we don't want to talk ourselves into it, but if we are heading into recession, would a trade deal, John, even matter to the equity market?
Oh, I think a trade deal will see an about face of all the predictions of recession. You'll see a ramp up of global growth expectations in terms of GDP, global growth in terms of earnings and revenues for corporations. We could have quite a rally from that. And then we'll likely have, after a quick rally, you'll have one of those I'm from Missouri, show me moments where let's see how it works out, okay? It's not like heaven on earth or anything, but the markets would likely be very positive on a deal.
So let's take it the other way. Clearly, Trump's Achilles heel is the election coming up, right? And so the Chinese know that. What are the odds that they just drag it out until even all these talks go on and they say, we're going to get a better deal if there's a recession in the U.S. and Trump is not reelected?
I think the likelihood then is whoever they meet on the other side of the election will have to carry forth on this, because the irony of it is as much as Trump's presidency is contested, it's unconventional. You know, it has a lot of detractors as well as supporters. But the big story is here, this is one thing both sides of the aisle can agree on, and Trump was the only worldwide leader who is willing to take on the Chinese. It's an extraordinary thing. Now, whether he did it for altruistic purposes, because it looked like a good pitch, that's up to him. Mark.
Hey, John, so assuming we get a trade deal done, how long do you think it takes for the economy to snap back, given that I think a lot of damage has already been done?
Well, the damage, ironically, has not been significant. If we really look at the first year of the trade war, which was 2018, the U.S. economy produced GDP growth of 2.9%. That was the best since 2016, and before that was the best since 2006. So that's extraordinary, not bad considering. Now, the damage is beginning to happen as the trade deal has expanded. More goods are implicated by this thing or impacted. But a lot of it's in planning. But today with technology, in terms of all kinds of methodologies for planning and execution, logistics, probably fairly quickly, but the markets as a discount mechanism would pick up on the idea of a healing to the global economy and move ahead of that.
I don't think it's just China, John. I mean, I think you've got, these worries about Europe, Germany slowing down. All the manufacturing and industrial production numbers have been pretty lousy. We've got this Brexit threat coming at the end of October as well. Argentina, which doesn't necessarily matter from a macro perspective, but it's another negative, another poke in the eye. The market, if you will, make the case for U.S. equity, or maybe I just did, that everything else looks so bad
do you think
that we just look good.
Is it an earnings growth story? Because basically, if you're going to get a rally, you know it comes from cyclicals, right? I mean, that's the nature of oversold bounces, which means you're arguing for sort of low quality, low margin earnings uncertainty, the things that are in many ways desperate. Not to say that you're making a desperate call, but that's what bounces most off of a low every time, right? So do you see that really happening? I mean, Glencore and U.S. Steel and big, heavy manufacturers and banks that are, struggling. That's the only way it happens.
Well, materials. When you get to materials, they tend to be one of the areas that really picks up on some kind of a turn. I'll never forget the first quarter of 2003. Everybody was still looking at their screens, looking at all the red and technology from the tech bubble, and all of a sudden, in the first quarter, I think it was March 31st, word came out: China's ordering a lot of materials. They're buying stuff. They're building stuff. wow, the market took off, and it was.
But John, I will make the case though that, and I don't know the exact number. It's 2003, but I would imagine the S&P 500 forward priced earnings ratio was probably pretty low. I mean, it got down in the single digits, I believe, at one point at the peak of the NASDAQ sort of decimation. Right? We're at 21 times trailing earnings right now.
Well,
is it the valuation different?
You know, my read on my terminal showed me that S&P 500 trailing earnings are at 18.5. Okay,
a little lower. I mean,
it's a little bit lower.
Depending where you look, you get some
different
different numbers.
They were pushing 20. So valuations are better than that from what I can tell. And then the other thing is there's a shortage of good equities. There's a huge need demographically for people to move out of the overbid that they've made on bonds and move into stocks. There are people who have objectives that are 3, 4, 5, 7, 10 years out that can afford to take a little bit of risk here with a portion of their money so that they won't have to worry about outliving their funds.
And so the recovery, where it happened, it's got to be either from multiple expansion or earnings growth, right? You're expecting a little bit of both?
It's an and/or.
Right, and/or.
Is
right.
what
That's
we
what
would expect. And so far, you know, when I look at it, Carter, we've got earnings growth of about 1.5% in the second quarter earnings, revenue growth about 3.4%. Bears would say, you know, that, well, the earnings growth is terrible, but the reality is revenue growth gives you a better idea, forward-looking, generally speaking. The other side of it is when you look at the whole world, when you think of Germany and the other countries that are suffering, a lot of it is because they depend on trade with China. And China's not buying a lot of stuff because they've got domestic problems at home in terms of their economy slowing that they're dealing with, and they've got the trade war. So,
oh, by the way, Hong Kong protests.
And both of us were in Hong Kong around the
recently.
Yeah.
John Stoltzfus of Oppenheimer. Target there, 29.60. Optimistic on trade, optimistic on the market. John, we appreciate you having us on. Thank you very much. You know, the one thing, Mark, we talk about with bonds, and I understand his point, but bonds have been, as an asset class, we always look at the interest rate. Bonds have done what? They're up 20% this year. The TLT has rocketed. It's been a great capital appreciation story.
It has, which is interesting.
But it can't continue.
It can. I mean, well, maybe it can. Who knows, right? I mean, there's all this negative yielding debt out there. Where else?
10-year yield go to zero?
I mean, it can go much lower because there's all this negative yielding sovereign debt out there. So where else does the money go? I mean, it's flowing into U.S. Treasuries right now, and that can continue to happen, and you can continue to see more appreciation there. I got to tell you, I'm not overly excited about jumping into bonds that are paying 1.6%, but if the appreciation is there, it could be attractive.
Simply, you're going to see rebalancing. People are now way overweight bonds. You're going to see that. Doesn't mean it's a quick gift for equities, but there's no question that people are over their skis. And I do think back to the market multiple, we should be trading higher, not because things are better, but because that's what goes on in this environment.